Hi buddies! Welcome to my channel. Today, we will take you on an in-depth exploration of a new financial tool that subverts traditional investment thinking, the Macro Sentiment Divergence Index, MSDI. Imagine that when you see the price of Bitcoin drop to $40,000 and the Fear and Greed Index shows extreme fear, do you want to buy the dip immediately? But in 2022, when Bitcoin actually fell to $17,000, those who bought the dip lost everything. Why? Because traditional sentiment indicators often fail before major market turning points. Let's first examine the three fatal flaws of traditional sentiment indicators. First, macro unconsciousness. They treat sentiment as a closed system, ignoring the core factors that determine asset prices, monetary policy, and liquidity conditions. Emotions become both cause and effect, without an objective anchor. It's like sailing on the ocean without a compass. You never know if you're on the right course. Second, signal blunting. In a one-sided market, sentiment indicators can remain in extreme zones for months. Bitcoin's persistent greed in 2017 and its persistent fear in the first half of 2022 completely invalidated the indicators. It's like seeing an oasis in the desert, but it's actually just a mirage. Third, there is the risk of homogeneity. The more popular an indicator becomes, the more crowded the trading activity becomes, and the lower its effectiveness becomes. When 90% of traders rely on the same indicator, it ceases to be an advantage and becomes a risk. So, how do we solve this problem? We propose the Macro Sentiment Divergence Index, MSDI, a new paradigm that deeply integrates sentiment analysis with macrofinance. The core idea of the MSDI is simple. Significant alpha opportunities arise not from extreme sentiment itself, but from significant divergences between sentiment pricing and macro-fundamental pricing. The MSDI's innovations lie in the market sentiment score. We move beyond traditional indicators and introduce more refined dimensions. In the macro momentum score, M, it measures not the health of the macroeconomy but rather its marginal impact on risky assets. Let's use the example of Bitcoin before the 2022 crash to illustrate. In Q1 2022, Bitcoin plummeted from $69,000 to $40,000 to $45,000. The traditional fear index, S equals 25, indicated extreme fear. However, the MSDI analysis showed a market sentiment score of S is almost equal to 25, confirming panic. The macroeconomic momentum score, GM, experienced a dramatic shift. CPI reached 8.5%. And expectations of Fed rate hikes soared from 3 to more than 7. The M value was extremely low, and after normalization, it was 20. The MSDI's near-zero reading indicates a near match between extreme market fear, S equals 25, and an extremely dire and deteriorating macroeconomic environment, M equals 20. This wasn't a bargain hunting opportunity, but rather a reasonable macro-driven decline. The MSDI signaled a strong risk-off stance. In the following months, Bitcoin plummeted to $17,600. Amid the Federal Reserve's fastest rate hike cycle in history, the MSDI successfully avoided significant losses from bargain hunting in this value trap. Let's examine the MSDI signal in March 2022. When the MSDI suddenly shifted from +2 to +8, the market was experiencing a divergence between sentiment and macroeconomic conditions, signaling impending volatility. The MSDI reading was well below zero, indicating a sharp divergence between market sentiment, extreme fear, and the macroeconomic environment, extreme easing. This was the perfect time to buy the dip. Subsequently, Bitcoin rose 150% in 30 days. Why is MSDI more effective than traditional indicators? Because it provides an anchor for pricing. It ties sentiment to observable macroeconomic variables, answering the key question of, is current sentiment justified? It's like using a star chart when sailing rather than relying solely on intuition. From lagging to leading, focusing on expected changes in macroeconomic variables, it can detect trend shifts earlier than simple price-derived sentiment indicators. The MSDI's lead averages 15 to 30 trading days. Avoid cognitive biases, effectively overcome the anchoring effect, and mean reversion illusion, forcing traders to respect the current macro-dominant logic. In an era when financial cycles dominate asset prices, any sentiment analysis that is divorced from the macro context is incomplete. As an analytical framework that integrates behavioral finance and macrofinance, MSDI provides investors with a powerful tool to identify strategic inflection points and manage systemic risks. Future research could focus on dynamically optimizing the weights of various macro factors and testing the index's universality across different asset classes. For crypto assets like Bitcoin, applying the MSDI is not only an optimization option, but also an essential component of risk management. Remember, it's not extreme sentiment that tells you when to buy or sell. It's the divergence between sentiment and fundamentals that reveals the true strategic inflection points. The MSDI helps us shift from emotion-driven to macro-driven, and from following the market to understanding the market. If you're tired of being misled by sentiment indicators, follow us and we'll decipher the market fog together. Thanks for watching, and see you next time.